Good afternoon, everyone. The UQ MBA Careers and Professional Development team would like to welcome our MBA students and alum, also a wider UQ Business School community, attending today's event, Entrepreneurship through Acquisition, with Nicholson and Rob Gaunt from SME Ventures. I acknowledge the traditional owners and their custodianship of the lands on which we meet today. On behalf of UQ, I pay our respects to their ancestors and their descendants, who continue cultural and spiritual connections to country. We recognize their valuable contributions to Australian and global society. Bonjour everyone, my name is Remy Decker, currently one of the UQ MBA Careers Consultant. Just before diving into today's webinar with Jake and Rob, please note that today's session is being recorded and feel free to ask questions on the Q&A chat box that will be asked once Jake and Rob have finished their presentation. I'm extremely pleased to welcome you all today, and this for a couple of reasons. Besides the fact my home country rugby team beat Australia last night in Melbourne for the first time in 31 years on Australian turf, today is the 14th of July. For those who don't know, we are celebrating on this day the 232nd anniversary of the French Revolution. So happy Bastille Day, everyone. Which leads me to the main reason on why I'm delighted to host this session, as our guest speakers are leading an entrepreneurial revolution in the Australian market. We all know entrepreneurs think and see the world differently, like space travel, as we saw this week with Richard Branson's commercial flight to space. Entrepreneurs can also teach us what the future of work could look like. They are known for creating new ventures that creatively solve problems, but it doesn't always mean starting your own business. It can be finding one that fits you and your skills so you can use your superpowers to change their fortunes. We also know work today is surrounded by uncertainty and turbulence. According to the World Economic Forum, the technology of the fourth industrial revolution, such as AI, pose huge challenges for the quantity and quality of work in many professional spheres. Investments move quickly between countries, massive new businesses emerge in the space of a few years, and long-established businesses can go bust overnight. These volatile circumstances profoundly affect how to do business. Therefore, in this session, we will speak about the fundamentals of search funds, entrepreneurship through acquisitions, how search funds are different from startups, and focusing on how to build a marketplace for search funds in Australia. We will also talk about the front line of search funds and what it's like to go through the process, and what are the things that really stands out from a searcher perspective, as well as what are the characteristics for a good searcher. Today we welcome Jake Nicholson, who is the managing director of SME Ventures and is considered one of the leading figures in regards to search funds in the current generation. He has been in the field for more than a decade and has a reputation globally for being one of the real experts in the search fund, entrepreneurship through acquisition, and all things related to that community. In addition, Jake teaches entrepreneurship through acquisition at INSEAD, from where he received his MBA and currently serves as entrepreneur in residence. Welcome, Jake.
Thanks for having me.
Also, we have got Rob Gaunt, who is a search fund entrepreneur at SME Ventures, currently looking and seeking companies to buy and operate. Rob was previously CEO at a marine rescue technology in the UK and obtained his MBA from Macquarie University. Welcome, Rob, and welcome, Jake.
Thank you. Thank you very much for having us.
Thank you.
Jake and Rob, would you like to kickstart the session?
Great. Thanks, Remy. First of all, happy Bastille Day. Hopefully we can lead a revolution here in Australia. That was one of the best intros I've heard for a webinar like this. So thank you very much for that. I'm going to share my screen here. Let me know if you have any trouble seeing it. As Remy mentioned, today we're going to be talking about entrepreneurship through acquisition. This is a topic about which I'm very passionate. It's a topic to which I've dedicated the better part of a decade to, mostly in the US, some in Singapore, and now bringing it to Australia. I've been an ETA, entrepreneurship through acquisition is abbreviated ETA. I've been an ETA entrepreneur. I've built 2 accelerators in this space, and I teach entrepreneurship through acquisition at INSEAD. And I could talk forever about this topic, search funds and entrepreneurship through acquisition. But the purpose of the next 15, 20 minutes or so is to give a brief overview of what this world is all about, introduce you to a practitioner in this space, Rob Gaunt, who has just said hello to you, and then provide you some opportunity to ask some questions. So before we start this discussion of entrepreneurship through acquisition, we have to first ask ourselves, what is entrepreneurship? The very conventional definition of entrepreneurship is usually starting a company from scratch, earning nothing, and living on instant ramen in your garage for years before you generate any revenue. And even then, there may not be any profit for more years to come. There's parts of the entrepreneurial ecosystem that are attempting to broaden that definition. And one of the directions that it can take is in the direction of entrepreneurship through acquisition. Howard Stevenson defines entrepreneurship as the pursuit of opportunity beyond resources controlled. He's a professor at Harvard. And when you think about this definition, the pursuit of opportunity beyond resources controlled, it feels very entrepreneurial to me and to many people who ponder it, but it's also much broader than starting a tech company from scratch in your garage. It means you want to build a house, you don't know how to build a house, you don't have a hammer to build a house, you don't have money to buy a hammer, but you're still going to go build that house. You're going to find some way to build it. If we narrow this world down a little bit more, we're going to talk about the search fund model, which is a specific type of entrepreneurship through acquisition that's been around since 1984. It was developed at Harvard and Stanford. It's performed very well as an asset class over its 37-year history. And we can talk about a couple of the reasons why. But this was designed as a way for typically a mid-career operator to search for, acquire, and operate a small business with the mentorship and capital of a group of investors, experienced investors and mentors. This is a model that has been around for a while, and it follows a pretty typical structure. And that starts with raising the search capital. A search fund entrepreneur is someone who wants to search for, acquire, and operate one business for the long term, typically 5 to 10 years. And that entrepreneur, in order to go down that path, will first raise search capital. And that's a little bit of equity capital to fund the process of looking for a company to buy. And that process takes 1 to 2 years, average about 18 months. And that capital comes from 10 to 20 investors who are typically high net worth individuals, ultra high net worth individuals, usually quite sophisticated, who are attracted by the return profile of this asset class, but also attracted by the prospect of working with a promising entrepreneur on one of these small businesses. This search capital is in the hundreds of thousands, and that pays for travel, an office, some data, some interns, and a living wage for that entrepreneur for that 1 to 2 year search period. Then once a target company has been identified, that entrepreneur, that searcher, will go back to that group of investors and raise a much larger check. Will also go to a bank usually and raise some debt capital to fund that acquisition. And investors who participated in the first phase, in that search capital phase, benefit from a 50% step up on that initial investment. That means for every dollar they invest in the search phase, they essentially get $1.50 worth of preferred equity in the acquisition vehicle. Every dollar invested at the acquisition phase buys them one preferred share. It's a 1-to-1 ratio. But more than that, those investors are attracted more by this pro rata right of first refusal. That means if they participate in the search phase, they get the right, but not the obligation to follow on pro rata in the acquisition. So if they contribute 10% of the search capital, they have the right, but not the obligation to contribute up to 10% of the acquisition capital. And they see this as a really cheap option on an attractive future lower middle market buyout opportunity led by a very promising, capable entrepreneur. Then that entrepreneur, that searcher, will step into the acquired company and run it as the CEO for the next 4 to 10 years. Average holding period is about 6, but there's a lot of variance around that. And over that period, that searcher will earn a carried interest in the deal. Some of that, and it's very substantial, but it vests in three tranches, typically. 1/3 upon acquisition, 1/3 over time, and then that final third is performance-based, usually calculated based on IRR at exit. And that exit is often to a private equity firm, sometimes to another industry player. There have been no IPOs out of search funds, but that is something that might be possible in a market like Australia. The default playbook here is you're buying something that's doing 2 to 5 million EBITDA, which is below the radar of most private equity firms. You're professionalizing it, you're optimizing it, and you're growing it into that radar where private equity firms are going to be interested and larger industry players are going to be interested. So the multiple that you exit at is going to be significantly higher than the multiple that you buy at. This model is actually already taught at a number of the top business schools around the world. It started in the US, as you can tell from my accent. That's where I'm from, and that's where I spent the first number of years working with this model. Over the past 5 to 10 years, it's really started to spread significantly in Western Europe, Canada, Latin America. We're very early days in the Eastern Hemisphere, but the formula and the opportunity are very clear on this side of the world as well. Like I said, the past 5 or 10 years, we've seen a significant uptick in the number of search funds launched. Again, mostly in the US and Canada, but an increasing number in other geographies as well. It is considered by many people in the space to be its own asset class because it has a pretty distinct return profile, differentiated from early stage venture and traditional private equity, but still very attractive returns on the whole. There is, however, some risk to both the investor and the entrepreneur, far less risk than starting a company from scratch. But for an average searcher that launches, out of all searchers who launch search funds, about 2/3 acquire, 1/3 wind down their search fund without acquiring anything. And then of those who acquire, about 3/4 produce a positive return for their investors, which means they've likely created some equity value for themselves. And then 1/4 produce a loss. Again, some risk, but far less than the sort of 90% failure rate that you see in the startup world. Australia paints a very clear opportunity. The Australian demographic picture is very clear for search funds. The kinds of businesses that are acquired are typically legacy, 20-year-old, predictable, often B2B service businesses that are being run by a retirement age founder owner who doesn't have a succession plan and really likes the idea of transitioning the business to a hungry, usually younger operator who's going to carry on their legacy, keep that business moving forward and do the brand proud. Now in Australia, you have a private equity market, but they really only come down to about 5 million EBITDA. And below that, you have a dozen or so deal by deal guys, but not nearly enough to absorb the number of businesses that need succession solutions and don't have them. It's about 83% on last tally of privately owned businesses in Australia have no succession plan. And the sad truth is a lot of these businesses are just going to die because there are no takers for them. But many of them can be great opportunities for a hungry entrepreneur to come in and add some value. When we compare for entrepreneurially minded people, they're often comparing these two alternatives: build something from scratch or buy. And it's important to weigh the pros and cons. Like I said, about a 90% failure rate when starting from scratch. That said, if you go the startup venture capital route, you're probably more likely to build a unicorn if that's your goal than if you buy an SME and add value to that. However, you're much more likely to fail completely as well than if you buy something that already has proven product market fit, already has a management team in place and willing to stay, that's been working together for a while, already has cash flows and therefore resources with which to create value. And often there's very often low-hanging fruit for that new CEO to go after that the former owner just didn't have the appetite for. This is very new to Australia, but it is, we've answered a lot of questions about the feasibility of this model in Australia over the past couple of years, thanks to the trailblazers in Australia. We have at the bottom, we have people who bootstrapped the search process. So they didn't raise that initial search capital, but they still wanted to go buy a company. And a bunch of these launched their search before it was very feasible to raise search capital in Australia. So Nick Bamford in Queensland, he's actually one of your alumni. Nikita just bought something. Johnson and Sahil bought something last year in Queensland. Jack Lancaster bought something last year in Sydney that perfectly aligns with his industry expertise. And they're actually looking at possibly IPOing in a couple of years. On the search fund side, there are 3 active currently in Australia. Rob, who we have here today, and he should have closed on a deal 2 weeks ago, but due to some delays at ASIC, that hasn't happened yet, but will imminently. And then we have Greg Green and Alex Simmons, who have both raised search capital and are actively searching for businesses to buy. So it's definitely, real in Australia, something that should be taken seriously, and we expect these numbers these numbers of entrepreneurs to increase significantly over the next couple of years. As the model has matured over the past 37 years, there have also been variations created on the model. There's that traditional search fund that we talked about, where you raise on your own and you search on your own and you buy on your own. There's the self-funded search for those who don't want to raise the search capital, who have enough savings and for whatever, they want to buy a particular kind of company, or they want to stay in a very specific geography, or they want special terms, or whatever it is. They want something that varies from the traditional search fund model, can choose to self-fund their search and try to buy something that way. Some private equity firms or family offices have adopted a variation of this model by bringing an entrepreneur, sort of entrepreneur in residence in-house and keeping them on the bench and letting them use their network and their time to go look for an acquisition opportunity. And then post-acquisition, that entrepreneur would step in and operate the target as the CEO. And then you have accelerators. I was fortunate enough to help build the world's first accelerator of search funds in the US, called Search Fund Accelerator, SFA. That has been a good success story. And now there are 14 or 15 accelerators of search funds around the world. SME Ventures is the one that I run currently in Australia. We have a unique structure that is meant to be a real partner to the entrepreneur throughout the process. And the idea behind an accelerator and SME Ventures in particular is that there's a lot of opportunity for wasted time and effort and error when a searcher is off doing this on their own, especially if they've never bought a company for themselves before, and they're just looking to buy one company. So it really doesn't make sense for them to build all these systems and processes and teams and pipeline for the first time, buy one company and then throw it all in the trash. There's a lot of inefficiency there and a lot of room for missteps. So we provide a structure, a partnership, a team, a tech suite, capital, a network to get that searcher up that curve very quickly, generate a high quality pipeline of opportunities, and partner daily through the transaction. And then post acquisition, we sit on the board and are actively involved, as well as that searcher is operating the acquired business. As I mentioned, Rob is an entrepreneur a searcher at SME Ventures, and he has found a company. He launched his search in October, and he's found a company to buy. And we're in the very last steps of closing on that company. And it's been an exciting journey. Rob has been fantastic to partner with. I'll let him tell his story, why he decided to go buy a company, as crazy as that sounds, and how the journey has been so far. And Rob, also maybe where do you see yourself in 5-10 years, and how does that align to the vision you had at the beginning of this journey?
Okay, well, thanks for that, guys. Yeah, look, I guess, my journey started in a pretty similar spot to what most of you are now. As Jake mentioned, I was previously involved in an SME over in the UK. I went over there to kind of start the sales strategy. They were looking at changing a bit of a direction with that, and slowly progressed through the company and ended up taking over as COO and CEO for the last couple of years that I was there. And that really gave me a flavor of, the amount of change that a person or a good team can bring about in a small business, and what you can achieve. So following finishing up there, I came back to Australia and started my MBA, and really didn't know what I wanted to do. I know I wanted to play in the SME space. I loved the autonomy that you can have. I love the fact that you're not just a small cog in a big machine, and that you can really institute some change. And I started looking at things to do. I think, like most people in MBA, we looked at consulting. Do you kind of branch into private equity? What are some of the usual MBA kind of routes that you can go to? And it was just by chatting to a friend of mine who went to INSEAD and attended the search course. And I said, I would love to find a good operating business, but one very similar to the one that I worked in before, that comes from maybe not as a sophisticated mindset, and implement and kind of start doing some of the things that we learned about. And he told me that what I was talking about fundamentally was a search fund. The response is probably like most of you is, well, what's that, and what does that involve? And I started going down the rabbit hole and started reading and learning more about the model. At that stage, again, it's only a couple of years ago, but there wasn't as many accelerators available as there is now. And, it's still very fresh in Australia. So when I started looking this as an option, the first thing that I thought is this really something that people do? I mean, I didn't particularly have access to a big investor base. I didn't know whether I'd be able to raise the search capital. I was confident of my ability to get into a company and run it once I was there, but it seemed like such a far step to it. So I started scheduling calls with people like Jake, and like anything, when you break the process down into little parts, it becomes a lot more achievable. So, I stumbled across search like that. In fact, quite a funny story is when I told my dad that I wanted to go do this. He's a fairly entrepreneurial person. He's had a couple of different businesses, and I said, I'm going to raise some money from some investors to buy a company. He burst out laughing. He said, well, first of all, who are you? Why is anyone going to back you? But also, if you think that you're going to get people to give you money to find a company to buy, you're crazy. That's never going to work. And so that was my kind of shock introduction to what I thought most people may think when you tell them about the search fund model. Fast forward, almost a year, and he's an investor in the business, and we're just about to close an acquisition. And he's a huge believer in the model now that he's had exposure to it. But I'm sure most of you are thinking, it sounds very good and very glamorous, going out and finding a company to buy, but is it achievable? And I guess I'm here to be the proof that it is, provided that you break that down into little steps. So that was kind of my introduction to search funds. I guess that also covers the why. I wanted to be in a position where I was in the driver's seat. These are companies that fundamentally are really solid performing. So as Jake mentioned, the sweet spot is between the kind of 2 million EBITDA to 5, and that flies right under the radar of private equity. But it's an established business. Obviously they've often got kind of sophistication issues. So it might be an owner operator that's had it for 20 years. And they're always just doing the same thing they've always done, but they've got a really good revenue and recurring customer base. So, there's a lot less pressure on the entrepreneur or CEO stepping in, because fundamentally the business is operating fine. Then it's just a case of saying, okay, how do I think I can bring some of the skill base that I have, or some of the experience that I have, and tweak these things to really scale it. And that's the thing that the investors love. They often, because it's from high net worth individuals or family offices, they have that connection with someone who's young, ambitious, probably hasn't been in this position before, but has the skill set and the mindset to go out and execute. It's obviously a lot lower risk profile because they are established businesses, which is great for them. But you can see by the return, it's very attractive for them as well. So they like the proximity, they like the fact that they're part of the journey, but obviously everything's return basis as well, which is something that's very attractive.
Great, thanks, Rob. So Remy, I'll let you guide the process from here on. I'm sure there are lots of questions in the audience. If you want to chat them in, we'll do our best to answer them. Otherwise, I probably know the questions that you have going through your mind.
Yeah, no, just thank you very much, Rob and Jake. That's very informative. Again, as a quick reminder, and I know that few students have been posting some questions on the Q&A chat, but I've got maybe 2 questions before we dig into some questions from the audience. And maybe the first one is for both of you. You spoke about investors, so I just wanted to find out what the search fund model actually looks like from an investor perspective and the searcher perspective. And if you could dig a bit more on how the search fund model mechanics works, if possible.
Sure, yeah, I can give you a quick overview. So again, 2 phases of investment. The first phase is the search capital, and investors, when they're investing at that phase, they're buying preference shares in an acquisition vehicle. No target identified yet, but the entrepreneur is there, and the entrepreneur says, look, I'm following this model. Here are my criteria. I'm going to go find a great business. Give me essentially some seed capital to go do that. And in exchange, you get a discount on those shares, and you get an option on participating in the next round pro rata. Then the searcher searches for a year or 2, goes back to those investors and says, hey, I found a great deal. He's been communicating with the investors this whole time, he or she, and says, I found a great deal. It's $10 million enterprise value. It's going to be $5 million of equity, $5 million of debt. I'm pretty sure I can get the debt from this bank because we've already had a couple of conversations. So please invest $5 million. From the investor's perspective, that's a 1-for-1 investment. So there's no discount on that investment like there was in the search phase, because there's less risk, right? The target has been identified. And they already know the entrepreneur because they've seen that entrepreneur search for a year or 2. So they're confident in that entrepreneur's abilities. The target matches the description that the entrepreneur gave at the very beginning of the search. So all is going according to plan. Here's the $5 million. The investors own all the preference shares in the business. And Rob, the searcher, earns ordinary shares in that acquisition vehicle as he operates the business and performs.
Fantastic. My second question before we dig into the question from the students is maybe for you, Rob. The question I've got is around self-reflection. Like you talk about the learning curve, so on and so forth. So I just wanted to find out what practical steps you took in terms of self-awareness as a search operator, and how you are going to build a team around you, and what kind of necessary skills you are going to get along the road, and being able to identify gaps and fill the gaps, basically, once the business is being bought.
Yeah, it's a great question. You know, there's, as Jake mentioned, there's really two phases in a searcher's life. They've got the search phase, and then you've got the post-acquisition operating phase. So, you know, I did a lot of reflection whilst I was doing my MBA as to what I wanted to do. And I had no set path. I knew that I could see the advantages of going down a corporate route. I think there's a lot of great things that come from that, and I understand why it's attractive. I did toy with that idea as well, but fundamentally for me, I wanted to do something where I had not just the hand in deciding on what the strategy was, but really played a key part in implementing that strategy and adapting it. So that always tended itself towards the SME side. You know, I guess when you start doing the common readings in the search fund world, there is a lot of focus on internal reflection and deciding before you commit, is this the right path for you? One of the things which is recommended by most searchers is to reach out to people who have done search funds, some of which have acquired, some haven't, some are still searching, and really just find out, you know, what does day-to-day life look like? What are the things that are, you know, the difficulties? What are some of the intricacies of it? So I started reaching out to people, you know, as simple as, hi, I see you're running a search fund. I'd love to know more. I'm thinking about doing this, and, you know, scheduling a call. And it's such a fantastic little world, and people have been in the same situation as you are, that they're very giving of their time. So I was able to learn a lot about what it actually involved in day to day. So that really solidified to me that, yes, I think I was on the right track. You know, I attended a seminar where Jake and Alex Simmons, one of the other searchers, was doing at PwC, and for me, it was something that resonated very early, possibly because of my experience in the other SME that I was involved in. So I had some of that practical side. Although, you know, it's different going up through the business to being the person who raises the capital, does the acquisition, and then follows through. So it was a big step up from what I had done, but I had pulled those levers before. I knew that I liked it. I'd seen some of the things that a team is capable of doing, and also some of the things that hold good companies back. And the search fund model for me seemed to align all the resource and elements necessary for what I could see to make a great company. So for me, you know, there was a fair bit of kind of self-reflection and making sure that it was something that I wanted to do. And remember, this is something that's got to line up with your family life as well. You know, you are searching for possibly 1 to 2 years, sometimes a lot shorter, but there's an element of uncertainty there. You know, when you're speaking to people outside of people in the search fund world, they often look at you like you're a little bit crazy, and you know, they question whether this is even possible, and you know, so there's those types of things, and you're comparing it to seeing some of your friends in those corporate jobs, and you know, in the nice buildings and expensive suits. So there's quite a lot to take in while you're looking at it. I would say my recommendation would be to reach out to other people. They'll be very giving. Do the readings. You know, there's so many articles written on it. See some of the success stories. It's very well documented. Speak to people who have not acquired as well, and go through anything like you would, because this is this is something that you're going to commit to, not just for the 1 to 2 search, but hopefully for a 5 to 10 year period afterwards. So you want to be sure that you're going down the right path. You're going to be taking in investor capital. Some of those will probably come from your immediate network or, extended network. Some of them are going to be from very successful people who you want to build up a connection with and can take through the rest of your life. So there's a very serious commitment side there that you need to make sure that you do first. But, there's a lot of resources available to help you with that.
Fantastic. Thank you, Rob. I might start with some questions now that are coming through. And there is a question from Adam, one of our MBA alum, stating that that's a very exciting concept that he never came across this before. He's been thinking about starting a business, but now we want to explore this path. So I'm very glad we are doing this webinar with everybody today. How does investors qualify search entrepreneurs? And what's your experience in healthcare and digital health in this path?
Yeah, sure. It can be a little bit baffling especially for an MBA student to think that they're going to be taken seriously, not only by a 75-year-old business owner who's been running this business for 20, 30 years and now is being asked to sell to a kid, but also by extremely sophisticated investors when they've never been a CEO before in some cases and are sort of midway through their career. But the model works because of not only what the investors are looking for in the entrepreneur, but also what everybody's looking for in a business. And so the model can work even if that entrepreneur hasn't had CEO experience before, but is smart, hungry, humble, and coachable. If they're buying the right kind of business, it can still work because the right kind of business has cash flow, has recurring revenue, has a management team in place and willing to stay, has good margins, has pretty straightforward operations. So even if that new CEO doesn't do a whole lot for the first 6 to 12 months, that business should still be fine. The wheels will still keep turning. But once that new CEO understands the business and is ready to really flip the switch, there is some low-hanging fruit that she can go after. And understanding that what the investor is looking for are those things that could make a great budding SME CEO, like analytical thinking ability, great smarts. The soft skills are super important. A demonstrated ability to lead and manage people. And also deep understanding of the path and commitment to that path of buying and operating a business for the long term, because there are going to be some rough patches and your resolve has to be pretty strong in order to make it through all those bumps. And then also that combination of entrepreneurial grit and confidence on one hand, and humility and self-awareness on the other hand, so you don't come across as an MBA jerk to that business owner and those 50-year-old employees that you're going to be managing, and also to the investors, and that you'll listen to advice and coaching because you recognize that you don't know everything. And MBAs have never, MBA entrepreneurs in particular have never been accused of being too humble. And so they're in this weird spot where they on one hand are doubting their ability to actually go out there and raise money and buy a company and be the CEO, but on the other hand, they have this entrepreneurial drive that says, I'm going to make it happen. But balancing that appropriately, I think, is pretty important, and being able to communicate that balance to the investors, I think, is pretty important as well.
Well, in terms of balance, and it's a nice segue for the next question, we've got Gabrielle, who has been asking lots of questions. So Gabrielle is one of our UQ MBA students from February intake. I might combine some of our questions in two. If you are offered a CEO role but there was no buy-in and the founders were still involved behind the scenes, would you be wary in terms of growth, capitalization and exit plans? So that's the first question.
Sorry, can you say that again?
Yeah, if you were offered the CEO role, but there was no buy-in and the founders were still involved behind the scenes, would you be wary in terms of growth, capitalization and exit plans?
What do you mean there was no buy-in?
In terms of
yeah, I think, Jake, I think what they're asking is if someone came to you and said, hey, you can be CEO of this company, and there's some investors behind the scenes, but they like to be hands-on in terms of the strategy, and you probably don't have the autonomy or the setup like we do in having a fairly set board of directors. What would be some of the things you'd be aware of?
And the second part of the question is, do some of you add multiple ventures at once, or you just concentrate on one?
Rob, you want to start?
Yeah. So I'll answer the first part of the question. Look, that is very similar to the setup that I had when I ran the company in the UK. So I was obviously a young executive. The business was owned by an Australian listed entity. I was one person on a board with a lot more experienced people. I was probably out of my depth quite a bit as well. And one of the things that frustrated me the most was that I was at the beck and call of what the listed entity wanted to do. And there was a big conflict between their investment strategy and what I saw the business was capable of. And, that came about in not just some of the things that we did, but, some of the resources that I wasn't given access to. I guess when I was looking at the search fund, I wanted to make sure that I was in direct control. Now, you're still going to have investors, you're still going to have a board of directors, but you are the one that goes and raises the capital. You're the one that the investors are looking to lead that. And again, it's not something that you have to have prior experience in. This is a on-the-job learning thing, and this is where the search fund takes in. And Jake's chuckling because I've gone through quite a lot of learning in this phase as well, and still am. You're the person that ultimately selects who the board is and looks at the different skill sets that they're going to bring to you and the business. And the board isn't going to be executive directors. They're going to be sitting there as resources you can call upon to assist you in growing the company. So I would probably be aware of what your levels of autonomy is. If you've got people behind the scenes that aren't, that possibly want to be a little bit more hands-on, it can be difficult because you're either in the business running it or you're not. And if you're not, you need to trust that person is doing the right job and that you back them. So there's a couple of things that for me, I wanted to make sure that I aligned right at the start. And that's kind of speaking to those exact points, being in control and being able to kind of make sure that you're the one driving it.
So to the second question, the search fund model is best fit for best fit for entrepreneurs who are just using it as a vehicle to get into that CEO seat of a mid-sized business that they want to operate. That's their goal, is they want to operate a business as CEO for a number of years, and the search fund they see as the best way to get there. If the goal is to build a mini private equity portfolio, that's a different effort. That's a different objective, and there are other models that are proven to work for that. But in general, that's not really what a search fund is designed to do. That said, once you buy a company, like Rob's about to close on a company, and we're already starting to look at possibilities of doing some tuck-in acquisitions that make sense to add to that platform post-acquisition.
Fantastic. I might also combine two other questions, one from Andrew and one from Adam, because the questions keep rolling in. So Andrew is asking, technically, how does the search process functionally work? Like, what is the day-to-day process of finding these companies to buy? And then Adam has got a question around, is there any particular businesses or industry that you focus on in the search fund? Could you provide some practical examples of types of size of typical businesses that you have been found for potential applicants?
Rob, you want to take the first one? What's your day-to-day?
Yeah, so look, this is a question that I get asked quite often, and it's something that I advise people to think about, because often the focus is on, can I raise the capital for the search phase? Can I do this? My question to most people is, picture you've got the capital in your account today. What do you do? How do you go about it? And that's something that I couldn't answer when I was starting to think of this. You know that there is a limited brokerage network in Australia. You've got to go out and find the specific type of business that you're looking for, and that could vary depending on your industry or what it is. But there's some quite common characteristics that Jake will talk about soon. So how do we go about it? How do we go about engaging this? This is where I started looking for an accelerator to assist with. So I wanted to partner with a company who specializes in the search phase and assist someone like me who didn't really know what to do in going about that. And that's where I advise reaching out to some of the accelerators. Look, I can speak from working with Jake in SME Ventures. There's a lot of learning in this. So there's primarily two methods. There's a proprietary method, which is an SME Ventures bespoke method that assists in identifying the industries that you want to do, going through and gathering data on companies in those industries, filtering out those companies that don't fall in the kind of prerequisites or requirements, and then assist in staging the reach out. Fundamentally, during the search phase, while you don't have an active deal that you're working on, it's not very glamorous. It's monotonous. It's like any sales role. If you've partnered with the right person, or if you're doing your outreach well, you're speaking with pre-qualified business owners who you've spoken to and said, "Hi, I'm looking at buying a company in this industry. From what I've seen on, blah, 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 I think you fall within my size range, would be interested in having a call." And then you speak to them, you go through the kind of qualification process, which you get very good at after having these calls every half hour, all day, every day. And it's until something that kind of sits within the characteristics of what you're looking for, that you then start to progress the conversation. So, at the first stage, while you're still looking for something to work on, it's fairly straightforward. It's very similar to cold calling, although it's slightly warmer than that because they are pre-qualified, but it can be difficult. I guess once you move into once you've got something, you've had a look at their financials, you think, yes, this is something that I'd like, that's when it starts getting a little more interesting. And I'll preface this by saying I had no M&A experience prior to this. I'd done an MBA. I knew what made a good business attractive or not. And again, that's where the accelerator will help you before you go and raise your capital, in actually knowing what is attractive and why. And then it's a matter of just matching up with what you plan. So that's when it becomes a lot more interesting. You're often doing all financial diligence yourself. Again, a lot of learning in that. It's different when it's something that could affect you and your family and the next 10 years of your life. You start, you've got to build rapport with the owner, and often these are people who have been doing something for a long time, and you're stepping in knowing nothing about the business or the industry. So there's a lot of different dynamics to manage. In the case of the business that I'm acquiring, the business the owner hadn't been involved in the business day to day for the last 18 months. So there's an existing management team in place that adds another dynamic that you have to work with, and all while you're going through it for the first time. So there's a lot going on, and it gets very exciting. The common thread that you hear on why search funds may fail is because they stop prospecting for new businesses while they are doing diligence. So on top of going through all this learning and managing all these different personality types, you're also having to continue prospecting. And And that is really difficult. I mean, it's by far the most common reason why search funds don't acquire. I knew it going into it. I said I wasn't going to do it. And if I'm truly honest, I probably still fell into the trap a little bit. So, you know, there's a lot going on day to day. And I guess the really exciting thing is you never know what that next phone call is going to be. You know, that could be the one. And the conversations are so varied. You're speaking to such different people. You get to know the industries really well. So it may be that a particular industry is attractive, and then it's just identifying where that business sits in the industry or in the competitive landscape. And you're drawing on a lot of different skills that you've learned through the MBA and through your past experience, but putting them into practice. So it can be tiring, it can be stressful, but it can also be exhilarating. And you know, once you have a company that you're excited about, and you go through the final stages of diligence, and you're negotiating the share sale agreement or whatever it is, and you're speaking to your investors, you're getting them excited, you're getting the banks excited. Wow, it's really something else, and it's not something that I've been exposed to before, but I absolutely have loved the process. That being said, you know, I won't sugarcoat it. There's definitely some difficult times in there. You know, you get your family asking a lot of questions each day. Have you found something? Have you not? What's happening with the deal? Blah, blah, blah. So there's a lot going on in a very short space, and you're the point of contact for all of it, which I guess is why we do it.
Other part of the question, what sorts of things do we look for in a business?
Or what industries, basically? Yeah,
the model's been around for a few decades, so we have a bit of data and a bit of pattern recognition on what works, especially with the typical searcher profile. And what usually works. So Will Thorndike is one of the most renowned investors in this model. And he identifies three things as his biggies. One is recurring revenue. So that level of predictability and necessity of that business's service or product offering is a good predictor of the ongoing, the enduring profitability of that business. Number two is high return on tangible capital employed. And basically what that means is enough of a ratio of margins to capital intensity. So we generally don't often buy asset heavy businesses, and we like good margins. And then three is some industry growth. So we generally don't like to buy in contracting industries, but that also doesn't mean that we're buying AI robotics companies. We're not looking for those skyrocketing bleeding edge technology companies, just some growth to rise the tide, to lift this ship. And then beyond, so that's sort of so what that means for industry selection is it's often a B2B services company, as is the one that Rob is buying mostly, because those tend to have long-term customer contracts or relationships. They tend to have a differentiated offering, and therefore decent margins, and they're asset light. Then you just have to find the industry growth, the right service industry that has some growth in it. At the company level, some of the things we already mentioned in this conversation, a management team in place and willing to stay we say between 1.5 and 5 million EBITDA. That's big enough to give you some cash flow to work with, and stability, small enough so that you're not competing with private equity on the entry. Fairly straightforward operations, and then some value creation opportunity, whether that's growth opportunities that haven't been gone after, or some margin improvement opportunities, or your obviously price, and that valuation arbitrage is a critical component. The ability to leverage is also important. So a number of things we look for, but the headline is you're trying to reduce complexity and maximize predictability in the short term, while leaving open the option to pull some lever that's going to add a bunch of value down the line. And it's hard. So to link that to what Rob just told us, I know we're running out of time, but when you're going through that grind of day to day, the same conversation over and over again during the search process, and you're like, and you're thinking, you know, holy crap, I just want to run a company. Why do I have to go through all this every day? That there can be a bias that develops where you're just hungry to buy something, and that to counter that, and buying the wrong thing is much worse than not buying anything. So you want to make sure that you surround yourself with the right systems and people and partners to ensure that you get to that finish line, which is not buying something, but buying a good opportunity that's going to carry you for the next 5 to 10 years.
Fantastic. Thank you, Rob. Thank you, Jake. Before we go to the last question, because indeed we are getting to time, I would ask our attendees if they wanted to put their name on the chat box as we are looking to see if there is any interest into an upcoming workshop around venture capital. So if you're interested to learn more about venture capital, please feel free to put your first name, surname into the chat box. My last question for you both is, obviously we've got MBA alums and MBA students attending this event and webinar. What would be your last tips for them if they wanted to go down this path?
Robbie first.
Yeah, my advice would be to go to the SME Ventures website, not because it's SME Ventures, but because there's a really great pool of resources that you can get access to for free that will help you explore whether this is the right avenue or not for you. There's a lot of articles, there's some great books, there's some awesome podcasts. Jake does a good blog on there as well, and he has access to a number of other blogs. So that would be my advice. Go there, have a look at the resources available. From there, you'll get an inkling of whether this is something you feel is quite exciting and could be a good fit for you. And that's probably when you've gone through that process that you can start scheduling some calls with people. Everyone is exceptionally giving in this community, so there is no right or wrong time to engage. It can be, hey, I saw this or heard about this from a friend, run me through it, and people are happy to do that, all the way to, I'm really considering this, what are some of the next steps? So that's what I would do.
Good. I was going to give almost the exact same advice. Go do your homework. SMEVentures.com/searchers. There's a big orange button that says send me those resources. And one of those resources you get is a reading list that points you to all these other blogs and books and podcasts and things. This is not the right fit for most people, this path. But for some people, it's an amazing, obvious fit. And those are the people that should pursue this. We are actively looking for the next entrepreneur to partner with in Australia. So I'm happy to be a resource as your students go through this discovery process. There aren't too many people on this side of the world that are in this world. So please feel free to use me, read up, listen to the podcast, talk to people, explore your options, and include me in that process. It's not a job. It's a decade-long, really awesome entrepreneurial venture in the prime of your career. So you want to be fairly confident that that's what you want to do.
Fantastic. I would like to thank you both, Jake and Rob, for attending today's session. Thank you, Rob. I know you are in New South Wales right now. Jake, thank you for attending from Singapore. Also, a big thank you to Laura and Adele, who are our marketing staff, who have been able to get this webinar set up. Just a quick update on our upcoming MBA events. Our next one is at our Brisbane CBD campus on the 18th of August. We've got 2 different sessions. You can book one or you can come to both. Obviously, they're very popular sessions. One is with Daniel Jewell around purposeful career planning. And the other one is with Dr. Diane Harner, the subconscious habits of thoughts. Fantastic speakers, fantastic events, and also we'll get croissants for breakfast. So I A hobby of mine is basically we have got a mentoring program up and running where an MBA alum at UQ is mentoring an MBA student. If you're an MBA alum attending this workshop and you graduated in 2018 and prior and wanted to become a mentor, feel free to reach out to us at mbacareers@business.uq.edu.au. And thank you very much for joining us. There will be a poll, like a survey to fill. So I would like you please to fill the survey that will help us to define our next events coming up and obviously try to tailor our services. So thank you all for attending and I'll see you soon. Thank you.